Bonsoir. Bonsoir. Good evening. Good evening to all members and guests. I'm Sophie Palmer, President of CFA Montreal. We are thrilled and pleased to host CFA Institute's Research Foundation, and we welcome all board trustees who traveled today to come to our city. You will be hearing all about the Research Foundation and about the joint brief that you have on your chair that's hot off the press. This is the brief that we wrote together, so you'll hear about it, so I won't go over it. But first I would like to introduce the man that's one of the reasons why I volunteer so much time to promoting the CFA designation. Yes, that's true. As president and CEO, Paul Smith leads CFA Institute and its more than 140,000 members worldwide in promoting the highest standards of education, ethics, and professional excellence for the ultimate benefit of society. Please join me in welcoming Mr. Paul Smith.
Thank you, Sophie, and good evening to everybody. My job really is just to say a few things about the Institute and then hand over to Jacques, who's going to tell you a little bit about the Research Foundation. But looking at the room, you've got a tough task. All of your fellow trustees have positioned themselves right at the back there. So I don't know what to make of that, really. But I think they're sending you a subliminal message in some way. They're right behind you. It's great to be in Montreal, and I'm thrilled to have brought the weather with me as well. I take full credit for this glorious summer's day that you're having here. It's wonderful to be back here. Last time I was here was for the annual conference that we had in May, which was a resounding success. As most of you will know, our largest conference ever. And all of the feedback that I've had since then from members around the world who attended that has been incredibly complimentary, not just about the event itself in terms of what was on the agenda, but about Montreal, about our society here, and about the welcome that people had in the city. It was a real tour de force from every possible direction, and I think you should all be congratulated for hosting such a great event, which reflected enormously well on you and very much so on the Institute as well. So thank you for that. A couple of words about the Institute. We carry on, as Sophie said. We now have 145,000 members worldwide. They are spread over 150 countries worldwide. We have 147 societies. We're CFAs, so we love numbers. 147 societies in about 80 countries worldwide. So that's the network. And then they're supplemented by 250,000 now candidates. So 250,000 candidates sitting all three levels. So roughly speaking, 50% of those at level 1, and then levels 2 and 3 split more or less equally between those two. And of those 250,000 candidates, 43% of them are Chinese passport holders. So that is an extraordinary stat, a good one. We think that it can grow from there, and I think it will. But also one that we need to manage, obviously. More and more, the income of the Institute is from the exam rather than from member dues, and that exam income is coming from Asia, where our members are actually based here in North America. So there's a challenge there as we sort of try to balance what we're doing. We're sort of, as I'm very fond now of saying, we're sort of performing a reverse Robin Hood act. For those of you who are versed in English folklore, which I'm sure everybody in Montreal is, you'll know that Robin Hood sort of robbed from the rich and gave to the poor. We're involved in the reverse of that at the moment. So I'm not sure that's either ethical or, more importantly, sustainable. So how we put more money back into the developing world is a big challenge. And what we are embarked upon at the Institute is really to say that what we're trying to do is to raise standards of professionalism throughout the industry, that the credential is just the start. The really important work is what is done in our societies, how we develop our membership, how we develop professionalism, continuing education network, how we interface with the regulators, with employers in our locations to help raise standards, yes, promote the value of the CFA designation, but more importantly, connect what we do with its social purpose of trying to make finance a force for good in the world at large. And our societies are absolutely on the front line of that process. And the Institute's job is to support you in that. So that's really, I hope, what I can do for Sophie to help her continue to devote the hours that she does to volunteering here in Montreal. That really you are the society, are the standard bearers for the mission, which is to lead the investment profession through education and ethics for the ultimate benefit of society. And that's the best way that I can think of doing it. So the Institute is your servant, not the other way round. I know over the years that sometimes has not appeared to be the case, but I can promise you it very definitely is on my watch. We are here to serve you. You are my bosses, and I take that very seriously. And anyone who ever thanks me for doing my role, the first thing I say to them is, I'm actually paid to do this. So it is a pleasure, and thank you for thanking me, but you really don't need to. I'm here because, not because I have to be, but because I'm paid to be. So you really don't need to thank me. I'm here to serve you, as are all of the people who work for the Institute, to help you with us build this wonderful profession into what we hope it can be, a sustainable future for us all going forward, one that we can be proud of, that connects us with our true purpose in life, which is to help everybody in our societies reach their full potential. So I'm going to hand over to Jacques, who is going to talk about the Research Foundation. Thank you.
Bonsoir, mesdames et messieurs. J'ai eu 5 ans des enseignements français et vis depuis 20 ans en Suisse, et mon français est toujours la merde. That is pretty much all you will hear from me speaking French tonight. So thank you all for hosting this event, and thank you all for hosting the Research Foundation of the CFA Institute. We are very, very glad to be here. In fact, I've double-checked with my colleagues. This is the first time ever that the CFA Institute Research Foundation board meeting is not in an English-speaking country or environment. And let me state that I can tell that from up here because I've never seen such a good-looking and intelligent audience as you are here today. Side note to my American colleagues on the board, I don't mean that, I just say that so they like me. But the Research Foundation is very happy to be here and to actually work with the CFA Montreal. We've been in existence for a little bit more than 50 years. In fact, last year we had our 50th anniversary. And the CFA Institute Research Foundation, if you don't know it, is a not-for-profit organization which is mandated to sponsor and create practitioner-oriented research. Research that is relevant for our members, relevant to the members of the CFA Institute, so relevant to all of you in your daily life. And we've been doing this for the last 50 years, and we've been doing this mostly through our publications. You might be familiar with our monographs, which are like little books, about 100, 150 pages long. We publish about 3 to 5 of them every year, and they investigate a topic in more in-depth. We've also published and publish frequently literature reviews on a specific subject matter, so in order to help our members kind of get up to speed on specific subject matters. Here in particular, I would like to stress that, for example, our literature review on Islamic finance has become quite popular over the years as one example. And about 1.5 years ago, we started to think about how we can serve our clients even better, because we're entering an age where people like me become old farts and are not that much up to speed with modern day behavior. And when I'm in my job, I tend to be the only one who still reads books, and I mean physical books, paper books, book, not ebook. So we noticed that people would like to have content, research content delivered in a more digestible format, in a shorter format. So we launched our research briefs. So shorter papers, a couple of pages long, 10 to 20 pages long, that should enable all of you and your colleagues to get familiar with a specific, narrower topic in a very short amount of time. And what makes this particular brief so special that you see here today is not only that we're gonna listen to some of the contributors of this research brief, but most importantly, it's the first time ever that we published and produced such a research foundation brief together with a CFA society. And CFA Montreal has been not only suggesting this topic, but has been incredibly helpful in putting this together, because it's based on the asset allocation seminar that you had here in Montreal a year ago. And we will hear from Craig Bodenstab in a short little while on his topic, which is the perils of forecasting. The entire brief is on portfolio structuring and the value of forecasting. And so in the rest of this evening, before I hand over to Craig, Craig will give a presentation. Once he's done, we will be joined by Jacques Lussier on stage for a Q&A session, because Jacques is the editor of this brief, and he can talk a lot about the contents here. And I'll just ask nasty questions to kind of throw them off balance as much as I can. But before we go to that stage, let me first do one more thing. As I said, we're incredibly grateful to CFA Montreal for their hospitality, for their collaboration, for all they have made possible over the last couple of months in the collaboration. And I've got here a little token of our appreciation. I would like to ask Sophie to join me up here, because it's a little, as I said, token of our appreciation to CFA Montreal from us. To kind of commemorate this, and to, as again, thank you very much for all you've done for us.
Thank you.
So that's enough from me. I'd like to hand over to Craig. Craig is a director at Orbis Investments, and since he's normally based in Bermuda, I think today he's really happy, given the weather down there at the moment, to be here with us. Thank you.
Thank you, Joachim. You're actually right in your last statement. We're very fortunate in the sense we have some clients in Quebec, and I get here once or twice a year. And I must confess, if you come from a country where there's not snow, actually I grew up in South Africa, but if you come from a place where there's not snow, coming to -40, even if someone says to you, don't worry, it's a dry cold, actually it doesn't make any difference. So thanks for the chance to be here today. I contributed one of the papers in the report, and a year ago when Jacques had asked me to talk, he said, you can talk on anything you want. And I think the tendency is to talk about something financial related or something about modeling. And I sat back and thought about one thing, and that is, if one is honest with oneself and you look at the record our industry has in forecasting, it's still quite sobering. We have so much enthusiasm at doing it. And I can only believe our clients continue to pay us so much money because we're consistently wrong that it must be worth something. And what I wanted to do today is, and I'm going to keep it at a relatively high level, but I actually want to walk you through a couple observations. One, I'll try to just give you some perspective on why I think forecasting is incredibly difficult. I'll look at some examples. We can actually look how the record of some forecasters has been, sort of as an industry. And they'll almost give you perspective on, okay, so if you are one of those unique individuals who can forecast, actually does it make a difference? So if you're able to predict the future, does it actually make a difference? And I'll try to spend some time, in my opinion, what actually really matters. I've been doing this for about 25 years. Sometimes it feels like about 65. The one question, and most of our clients know we're stock pickers, but the most common question I still get from all of our clients is, Craig, what do you think is going to happen to the Canadian dollar? Or what do you think is going to happen to the S&P 500 or the price of oil? And I always respond the same way, saying, actually, I don't know. And I almost want to say, actually, that's a stupid question. But I've learned to actually, saying that to your clients is probably not a good thing for business. But I've also learned, actually, and it's interesting, saying I don't know is not good for business either, because clients have a view. And they tend to not want to hire firms or people who don't have a view. And so I find when clients ask me a question, I say, I don't know. It's almost one of disappointment and two of, well, why have we hired you if you don't know? And I think it's actually our clients' need for professionals who can predict the future that we sort of support this habit. I mean, our clients insist we know, and yet we participate in this particular habit. So let me get started. The first thing I'd like to spend some time on is, okay, so why is it so difficult to forecast? I mean, lots of smart people in the room, lots of smart people in the industry. Why is it so difficult to forecast? I'll walk you through a couple of slides here. Sorry, if you don't know what that is, don't put up your hand, because it means you missed your grade 12 chemistry classes. Look, it's a periodic table. It's a chemistry periodic table. And it's essentially an accumulation of everything chemists know and work with. And I think the first periodic table came about in the mid-1800s, actually in Russia. And what's fascinating about topics of study like math, chemistry, biology, physics is you can describe those studies as cumulative in the sense that new things you learn, you bolt onto old things you already know. And you can count on previous relationships to hold very well. So if you're a chemist and you go to work, 2 parts hydrogen, 1 part oxygen always equals water. Actually, it doesn't matter what the central banks are doing. Doesn't matter if there's negative real yields. Actually, those relationships hold very well, and you can count on that all the time. And if you think then about economics and money management and finance, actually our discipline is additive in the sense that what we do and how we react is a function of our experiences. And so our industry is different in the sense that if you want to know how individuals are going to react or how the future is going to play out, you're ultimately trying to predict how our individuals are going to react, and individuals tend to react based on their previous experiences. If you've done things that you've made money in, you tend to go back to that. And if you've lost money doing something, you tend to stay far away from that. So first thing you have to understand is our industry is very different in the sense that one, individuals drive ultimately what happens in the future, and how they act as a function of their previous experiences. So philosophically, it's very difficult to get your head around that. We also tend to think that this must be something only our generation is thinking about. Surely this is something no one previously has thought about. And I found this saying a long time ago. So Lao Tzu was a contemporary of Confucius. And he said, I won't read it, but those who have knowledge don't predict, and those who predict don't have knowledge. And I think what he's saying is, wise people probably recognize the limitations around trying to predict the future. What's fascinating is this was written more than 2,000 years ago. So human beings, as long as we've been on the planet, have been fixated with trying to predict the future, mostly because we don't like uncertainty. And if you think about our industry, the sheer number of people trying to predict the future means every year someone's right. So it's a little bit like we could have 50 coin flippers up here, and about half of them would probably call it right. And you kick the other half off the stage, and then that half would flip again, and half of them would get it right. But after a while, you'd have some very good coin flippers. They'd probably write books. We'd have them on CNBC. They'd make lots of money. Actually, the question is, when you have so many people doing things, someone always gets it right. And I'm always amazed when forecasters are introduced on TV or wherever they never talk about their record. They always talk about something they predicted, something they got right, but they never actually talk about their record. The issue you want to know is not, Did someone call the tech bubble? Did someone call the Canadian housing bubble? Of all the predictions you made, how many did you get right? It's amazing. In our industry, we collect lots of data, but no one ever talks about forecasters' records. So, just for the record, those are different people. So Nostradamus on the left, the 16th century French prophet. And I'm happy many of his predictions haven't come true. We wouldn't be here today. Obviously, Jim Cramer on the right, the host of Mad Money. I mean, even just the fact that you have a show on managing money called Mad Money. I mean, you know, imagine if you had mad doctors or mad medicine. I mean, would people take it seriously? I obviously don't know either gentleman, so let me put that on the table. But I suspect what they both had in common is they were confident and quite self-assured. And there's been tons of work done by psychologists, and that is we listen to people who speak well and who come across well and who are confident. Okay, so observation number one. Point number two, there's a horrible feedback loop in the sense that if individuals think they're smart based on how much they're paid or whether we tell them they're smart, actually they become more precise in their forecasts. So the smarter individuals believe they are, the more precise their forecasts become. Okay? And it's interesting. I'm sorry, I don't mean to knock the actuarial profession, but if you ever ask an actuary a question, everything's some number, comma, something, something, something. Everything's got 3 or 4 decimals to it. But then if you look at their models, you just change 1 or 2 assumptions in actuarial model, I mean, you'll change the whole number by a massive amount, but it appears incredibly precise. Neuroscientists we're learning lots about how the brain works today. Neuroscientists have also done a lot of work, and what you find actually is you can have individuals faced with choice, so the choice between something that involves risk and something that doesn't involve risk. And actually individuals tend to make fairly good decisions. The second you introduce an expert opinion, that part of the brain that thinks about making rational choices actually shuts down. So the second an expert opinion is introduced, individuals start to make bad decisions because they're relying on the expert opinion. Let me spend some time just walking through actually our record as an industry of forecasting, and you can form your own view as to how well we've done. I have a few slides here, and I'll just explain the slide first, and then I'll flip through them fairly quickly. Obviously, you'll have time on the horizontal axis here, and you'll have some metric on the vertical axis. In this case, I'm looking at US inflation rates over the last 30-odd years, okay? And so the first thing I do here is I show this is what actual inflation in the US has been over the last 30-odd years. So fairly obvious, you'd be familiar with that data set. Every year, the Philly Fed, or the Federal Reserve Bank of Philadelphia, goes out and surveys professional forecasters and gets their professional forecast for where inflation will be 1 year forward. Okay? And actually, the basket of goods that goes into inflation, it's not that complicated. It's really looking at the price change of a basket of goods, essentially the CPI. And they go out and they ask these professionals for what their forecast is 1 year forward for where inflation will be. And this is what they produce. I mean, not bad. I mean, if you just look at it from a graphical perspective, actually not bad. Slight problem with the data in the sense that this is what they said inflation would be 1 year forward. Okay? So to see apples to apples, I need to lag the data 1 year. And I'll do that. It looks something like that. Okay. Now, actually still not too bad. I mean, to be honest with you, still not too bad. So let me try to give you a sense from a mathematical perspective, how good is their forecasting ability? Many of you have done the CFA. Think back to sort of statistics in your first or second year, the coefficient of determination. Effectively, that statistical method that allows you to say, how good is a model at predicting the outcome? Okay? R squared of 100 says this model is really good. R squared of 0 says chuck it out. It's actually worth nothing. Okay. And what's fascinating here is, I hope everyone can see on this side here, what I've done here is I said, okay, what's the predictive ability of their modeling or their estimates based on the unlagged data? So i.e. January 1st today, someone says, what's inflation going to be 1 year from now? Actually, that number that I give tells me a lot about where inflation is today. It tells you actually much less about where inflation is going to be. And that's a very common issue with forecasters. It's called anchoring, in the sense that where we are today, you assume is right. I mean, with all due respect, you think to CFA studying, when you model company financials, you always start with the current financials, you sort of go from there. I mean, it's very typical in forecasting. You take what's happening today, and that almost becomes the right number, and you work with that. Okay. So just as an aside, you may be interested to know that the best forecasters in the world actually are people who forecast the weather. And what's fascinating is they have by far the best record of predicting the future. Now, granted, they've got lots of fancy systems, satellites, and they also have an amazing feedback loop where you can look out the window, but they have by far the best record of forecasting. And what's the most fascinating is they're the most humble about it, and they're the least confident about their ability. And I think it's because we don't hold them in very high regard. I think it's because we don't allow them to write books, we don't interview them. Yeah. If your children bring home a weather person, you're semi-impressed. They bring home someone in finance, you're quite impressed. Being a good forecaster has to have a function of being very honest. Weather people are actually incredibly honest about the limitations of their profession, and ironically, they have by far the best record. Okay. So let's just continue down the list of examples here. So if you're familiar with the chart, effectively a table, you've got time on the x-axis, vertical axis, now we have 10-year treasury yields. Same thing, the Philadelphia Fed goes out and says, two individuals, where are 10-year treasury yields going to be 1 year from now? This is what the actual data looks like. And they go out and they ask the professionals. Same thing. Okay? And you say, well, Craig, tell me about it from a statistical perspective. It looks something like that. So effectively, what they're telling you is their predictions for where 10-year yields will be 1 year forward tells you a lot about where 10-year yields are today and much less about where 10-year yields are headed. Okay. Now, I know you don't hold economists and bond analysts in high regard because many haven't done the CFA, so let's look at how equity analysts do. This is usually where I get chucked off the stage. So IBIS probably has the largest data set of collecting earnings forecast data. And so what I've gone back here is sort of 30-odd years, the longest uninterrupted series of earnings data in the S&P 500 looks something like that. So that's the actual earnings of the S&P 500 companies over time. Inflation's a wonderful thing, so it always looks like companies are making more money. We overlay on top of that forecasted 1 year forward estimates from effectively our industry. So, with all due respect, actually not too bad. We're certainly an optimistic bunch. We always are forecasting earnings to rise, but be that as it may, and I'll lag it forward 1 year. So this is only 1 year forward, okay? Looks something like that. And then back to the same model, Craig, how does this look from a statistical perspective? How good is the forecasting ability at actually predicting where earnings will end up? And the numbers look something like that. So very telling to where earnings are now. But if you said to me, actually, Craig, with all due respect, 95% R squared actually is very good in terms of our ability to predict the future, i.e. 1 year forward earnings. Actually quite impressive. And I'd say I think that's a fair point. What if I said to you, you could spend the entire year at the beach and come in every year and use as your forecast where earnings are today? So forget your spreadsheet, forget any studying. Just go away to the beach, come in once every year, and your forecast for where earnings is going to be 1 year forward is just where current earnings are. Okay? I'm going to show you, if you do that number, I'm going to put it in here, what the R squared looks like. So just to recap, you do no work all year, you go to the beach, you come in, 5 minutes before this is due, the number you put as your forecast is where earnings are today. So in fact, you should go to the beach. There's no difference between what we predict where earnings will be, and in fact, taking current earnings and using that as the forecast. Okay? And yeah, I was going to say something, but I just see the camera there, so I won't say it. And I think this is a fair point. What if we take a slightly longer view? Let's look forward 3 years and look what earnings forecasts are like over 3 years forward. And so the same chart, I just showed you the earnings, the actual earnings, and I overlay over here, so 3-year forwards. And the numbers slightly jump here because every year you're making a 3-year forward forecast. I'll do the same here. I'll lag them forward, so 3 years. And I'll provide you the data. If we're honest with ourselves, actually in the last 30 years, we haven't predicted a single downturn in earnings, and there's been 3 major downturns in earnings. We are still miles away from the predictions we made in 2011, where we thought the S&P 500 would be. Okay. And what's probably most worrying is analysts have access to company management. I mean, if you look at some of the models we have, if you look at how deep some of these teams are at trying to forecast earnings, I mean, the reality is actually, I think we do a fairly good job of it. But unfortunately, even if we just copied where earnings are today, actually you would do as well as all of us do professionally. Now, you may say, well, Craig, with all due respect, can't we look at other markets? So let's look at this market. Let's look at the, I guess where David lives in Hong Kong. Let's look at the Chinese market. And I love the listing criteria for the CSI 300, which is the Shanghai Shenzhen largest stock index. And the way you get listed there is you can't manipulate your stock, and your stock can't be volatile. And if you don't do those 2 things in China, then you can be listed, okay? This is essentially what the CSI 300 has looked like for the last 10 years. It's the price of the CSI 300. That's essentially what the forecast made by analysts for where the index will be 1 year forward. I lag it. And then if I give you the data, we have no clue where the Chinese stock market's headed. Sorry, in my opinion. And if I was in Alberta, I probably wouldn't show you the next slide because the guys would carry me off the stage. But let's look at the price of oil. Okay, so it's the exact same thing. This is spot price for West Texas Intermediate, effectively the base commodity for the CBOE. Same thing, we ask professional forecasters, where is oil 1 year forward? So not very far, 1 year forward. And the numbers look something like that. And then if you say, Craig, how does it look statistically? We have 0 clue what's happening to the price of oil. Okay. I know what everyone's thinking. You're thinking, Craig, with all due respect, you're probably just getting forecasts from a bunch of Americans. We're Canadians. We have better insight. Every year, Mercer puts out what they call this fearless forecast, and they get estimates from professional money managers to where they think various asset classes are going to be. And for some reason, I can't find the 2015 one, so I apologize. This was essentially, and many of you may have been surveyed, this was essentially what you said the 2014 returns would be for those asset classes. Okay? These were the actual numbers, and that's the difference. So 1 year forward, we had 0 clue what was going to happen to the long bond, or sorry, any bonds for that matter, and we didn't see anything coming with regards to the devaluation in the currency. I'll send you that if you want it. Yeah. And that's just 1 year forward. And actually, I've seen much worse ones by Canadian professional investors. So I've given you a fairly good slide here. Now, let me share with you something else. We spend immense amounts of capital trying to figure out what the US government's going to do, because the US government sets policy. So fairly easy, the Congressional Budget Office hires some of the smartest minds in the world, and every 10 years, on a rolling 10-year basis, they give Congress a fairly good sense for what the fiscal position will be in the US government 10 years forward. And I just happened to find this about a year ago. This was essentially what the Congressional Budget Office said in 2001, what the fiscal balance would be in America 10 years forward. Okay? So in 2001, end of the Clinton administration, they said this is what we will have as a positive balance 10 years forward. Okay? So let's see, how did that work out? So unfortunately, the economy was a little bit slower than they anticipated, so we have to knock $3.5 trillion off that amount. The Bush tax cuts, which they hadn't anticipated, you have to knock $1.6 trillion off that amount. There was some discretionary spending that was a little bit higher than they'd anticipated, so knock $1.5 trillion off that. 2 wars showed up, so the $1.4 trillion there. Interest on the debt they hadn't anticipated. there was a shortfall in other revenue, and they spent a bit of extra money. But when you look at the math, they were out about 12 trillion. So over 10 years, they were out $12 trillion in their estimate. Okay. I could keep you here for days with slides where our industry struggles to make good forecasts of the future. Let's just change gears for a second. What if you could predict with some degree of confidence economic growth? And we spend tons trying to predict GDP. GDP above or under consensus moves markets. And this should be something fairly easy to work out. If GDP matters, then there should be a positive relationship between real economic returns and real GDP growth. And we can look at that fairly quickly. Okay? And what I've done here is I've said, let's plot on the x-axis here, annualized real GDP per capita growth. And I've taken 83 countries, and I've gone back and looked at 183 different 10-year periods and said, okay, let's see how that works out. Over here are annualized real equity returns. And if there's any relationship between real GDP per capita growth and real equity returns, you'll see something moving up, something like that. Well, those are the numbers. So there's no relationship between real equity returns and real GDP growth. And if you want to put a statistical lens on that, the R-squared is about 1%, or said another way, 99% of the variability in real equity returns is explained by things other than real GDP growth. Now, what if you just took the extremes, the country that grew the fastest and the country that grew the slowest? Would that allow you to make better investment decisions? Okay, so let's look at that. What I've done here is I've said, let's go back to 1900, so the last 110 years, and find the country that grew the fastest and the country that grew the slowest. And then look what real equity returns have been in those markets. So we'll take the extremes. And you have South Africa down here. So South Africa over the last 109 years grew the slowest, slightly more than 1% a year. And Japan actually grew the fastest, almost 3 times as fast at 3% a year. So for almost 110 years. Okay? If there's any relationship between real economic growth, or GDP, and real equity returns, you should see something that trends up like that. In fact, the data looks like that. Okay. And you have to ask yourself the question, how is it possible that the country with the slowest real GDP growth had a stock market that grew twice as fast as the country that was growing 3 times as fast as it? Let me just repeat that. How is it possible that the country that grew the slowest in terms of real GDP growth, a third, or the country that grew the fastest, grew 3 times as fast, yet its real returns over that 109 years was less than 4%, and it was close to 8%. So the country that grew the slowest, its stock market grew doubly as fast as the country that grew the fastest. And the question you have to ask yourself, why is that? In my experience, it comes down to one thing, and that's growth. Growth tends to attract high expectations. High expectations tend to attract optimism. Optimism tends to bring with it disappointment unless earnings actually come through. And you think back to the word in expectations. Expectations in investing is very much like dating. If you date with high expectations, you'll always be disappointed. You're much better off to date with low expectations. Much better. Investing is very similar. And conversely, if you think, well, what does growth do? Growth also attracts competition. Competition means you have to spend more money on innovation. More money you spend on innovation, less money for your shareholders, less return on equity. Let me take the example slightly further. Imagine with perfect foresight, and there's enough individuals in the room who'd remember this. Imagine if you could go back 20, 30, 40 years and say, I know exactly what's going to happen. And let's find the biggest surprises and see, okay, if you knew these big surprises were coming and you positioned yourself accordingly, how would it have worked out for you? And by far the biggest surprise we've seen in the last 40 or 50 years has been the extent to which technology has boomed and the headwinds faced in the tobacco industry. So we can go back to the mid-70s when there was really no sign of a headwind in tobacco, and we can short those tobacco shares because we know what's coming. We can go back and we can buy these tech companies because we know the boom that's coming in tech. Now, with perfect foresight, we go back and we put this trade on. How has that turned out for us? And remember, back in the 70s, we were smoking in restaurants, airplanes. Doctors were giving medical smoking. There was no sign of these headwinds coming. Okay? So very easily, with this perfect information, you go back, you buy tech, you short tobacco. How's that turned out for you? Okay? So fairly easy chart to understand. I've got years here, so 1975. And then the value, I'll start to plot everything from here. The value of $100 invested in the businesses I'll quickly share with you. So your investment in IBM, which was the largest technology company at the time, I mean, not bad. It's 46 times your money. Better than inflation, but unfortunately actually worse than the stock market. Okay. Now, the business you're sure that's not going to do well, which you've shorted, was Philip Morris. They've changed the name to Altria now. But this is what's happened to Philip Morris over the time. And remember, this is the industry that's faced massive headwinds. So Philip Morris is now 1,800 times your money compared to IBM, which was 46 times your money. You've done 40 times better buying the business that you knew with certainty had the biggest headwinds coming its way. You'll say, well, Craig, with all due respect, you've just cherry-picked the best ideas. Let's take the next biggest tech company and the next biggest tobacco stock. The next biggest tech company at the time was Digital Equipment. It was bought by Compaq in the late 90s at about 7 times that $100. British American Tobacco, the second biggest tobacco stock, has done that. About 6,000 times your money. So even with perfect foresight, knowing how the industry was going to play, you knew this. Actually, it's been a disastrous investment. And in my experience, this is the key thing we miss when we think about forecasting. It's actually not the growth in the industry or the growth in the market or the country that's relevant. It's the growth in competition, which is incredibly difficult to predict. And think about it this way. So the technology industry grew massively. But with that growth, attract massive competition. The incumbents at the time actually didn't know how to deal with all these startups. So the amount of capital spent trying to protect market position, develop new products, etc., actually meant there wasn't a lot of capital left for investors. And actually, on average, the tech space has been a disaster for most investors. We know of the success stories, but it's been a ruthlessly competitive industry, so the growth has attracted lots of competition. Tobacco, the opposite. Tobacco had massive lawsuits, ban on advertising, state, federal liabilities, shrinking market. But what happened? Actually, companies left the tobacco industry. And no one wanted to go back in it because, one, it felt dirty, but two, also we knew the headwinds it faced. So the incumbents that remained could pass on all the fines, all the expenses. They didn't have to spend anything on innovation. You think about the tobacco industry, with the exception of possibly e-cigarettes now, there's been no innovation for the last 30 or 40 years. So you spend nothing on innovation, you've had no competition, and all these levies and fines you actually could pass on to your consumers, and all the increased price you passed on to your investors in dividends and more earnings. And I suspect if we're honest with ourselves, this is where I'd love to press stop on the recording, 70 or 80% of us in our industry actually don't even earn our fees. Let's repeat that. 70 or 80% of us actually don't even earn our fees. We don't generate enough alpha for our clients to cover the fees we charge. And in my opinion, I think we focus on the wrong things. And in my experience, being in this business for 25 years, the only thing that matters is the price you pay for an asset. In my experience, the price you pay for an asset will tell you everything you need to know about the expectations someone selling you that asset will have for the future. You can make a much better decision then about how this is likely to play out. And if I just take those two bookend countries, South Africa and Japan again, and just look at it this way for a second. And this is financial analysis 0, okay? So this is nothing. Just watch this for a second. So what I've done here is I've said, okay, let's go back to 1973 when we get the best quality data in Japan. And I'll take the Japanese stock market and break it into equal quintiles, so sort of 20% blocks. And I'll look at the PE ratio like that. So that's essentially, since 1973, The cheapest 20%, the topics has been 16 times earnings, 20 the next cheapest, and the most expensive 47 times earnings, okay? You then say, okay, what has been the subsequent 10-year returns paying those types of multiples for the Japanese stock market? And you'll see there's an inverse correlation to the price you pay for those earnings. And just to be clear, this is financial analysis 0. I'm just saying take the price divided by the earnings. Don't even think about the sustainability of the profit or the enterprise. Just think about the multiple you pay to earnings. Do the same with South Africa, the exact same analysis. And I said, let's go back, but now let's do it slightly deeper. We'll look at the PE based on actual earnings and trend line earnings and get a sense for the multiple I pay here to earnings. What has my subsequent annualized 4-year returns been? And through both trend line and actual earnings, they look something like that. If you think about it from a statistical perspective again, the R-squared is about 30%, or said another way, 30% of what explains subsequent 4-year real returns explained just by the PE multiple, or the ratio you pay to earnings. I have 3 other slides in here I didn't have in the last presentation I gave to the CFA Society in this, and someone asked me the question afterwards and said, well, Craig, you've just taken 2 countries, Japan and South Africa. What about the rest of the world? And what I've done here is said, okay, let's look at something very simple. If you did nothing other than think about kind of that most basic valuation metric, price to book ratio, and you said, just buy the cheapest half of the market, how does that turn out? Again, no analysis, just buy the cheapest half of the market, do this every week, how has that turned out for you? It's a fairly easy chart to understand. So on the, sorry, it's a little bit more complicated, I apologize. What I've done here is I've said, take the multiple you pay for the cheapest half of the market, divide that by the multiple you pay, price to book again, for the market overall. So effectively, if I'm moving this way, my portfolio of the cheapest half is cheaper. So it's price to book multiple of my shares, which is the cheapest half, divided by price to book of the market. Okay. And essentially what you find is the data looks something like this. So this is buying it every single week, seeing what the subsequent 4-year returns would be. It looks something like that. So, and you say, well, Craig, what does that mean? 63% of the time, I beat the market. And on average, my median return was 1.4%. Okay. Now, this is a difficult trade to put on because every week you're putting the trade and there's lots of overlapping periods. But the point being, just by buying the cheapest half of the market, just by focusing on price, actually allowed you 63% of the time to deliver alpha relative to the rest of the market. And I'm trying to focus here on price being the most important thing. You said, Craig, what if quality became a factor? What if I thought about quality? So let's do the same thing, but you just buy the most profitable, those businesses with the highest return on equity. So again, exact same market. Rather than, I'll ignore price to book for a second, I'm just going to buy that part of the market where the best businesses are, and I'm judging best by highest return on equity. It's the exact same thing. Data looks effectively something like that. 72% of the time, buying the best businesses yielded on average 1.7% median return. This is alpha, so this is outperformance, okay? Now if you said to me, Craig, what if we took those overlapping stocks, those that are the cheapest and have the highest return on equity, called quality at a reasonable price? How has that turned out? So exact same slide. What I've done here is I've plotted those stocks that were the cheapest and also had the highest return on equity. And I've just picked those stocks. So obviously it's a smaller sample. And the data looks something like that. So 75% of the time, roughly, that's a winning trade. Now, a difficult trade to put on, but the point I'm trying to illustrate, in my experience, is price is probably that penultimate thing that really matters. Price tells you what someone is selling you an asset for, their expectations for the future. That's a much more effective way for you to say, does this feel right or not? In fact, even if you can predict the future, whether it be GDP growth, what an economy is doing, what a cycle is, it's not clear to me actually it makes much of a difference. So I'll end with 2 points. The bad news is, actually I think the macro forecasting doesn't make a difference. We spend billions as an industry on it. It's not clear to me it makes a difference. And even if you get it right, It's actually not clear to me it makes a difference, mostly because it's the increase of the change in competition that really matters. The good news is, actually the thing that's most important is entirely in your control, and that's the price you pay for assets. And I have to finish and leave you with one saying. This is from Mark Twain, and he said, "It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so." I'll leave you with that. Thank you very much.
Thank you, Craig. That was certainly a very thought-provoking and inspiring presentation. Please have a seat. I'd like to ask Jacques Lussier up onto our little podium here to take your questions. And while Jacques is making himself comfortable, a few ground rules. If you have a question, please raise your hands. We've got microphones here, one static in the middle. So if you're not shy, please come forward. And I can, Larry, are you already opening up the debate? No. Otherwise, we have Veronique, who has a portable microphone and will help you out. If I may summarize your presentation, Craig, with another quote that you haven't used.
I look forward to hearing that.
Huh?
I look forward to hearing that.
It's a very simple quote that I always tell my colleagues is there are two types of forecasts, lucky or wrong. And that really is my experience. And a little personal anecdote, the research that you showed that just assuming that the price of the stock market in 1 year's time is going to be where it is today and the price of oil, etc. Yes, you said in the beginning, I don't know is not an answer that our clients appreciate. I first tried that about 10 years ago when I first saw the research coming out on that topic. And for the last 10 years, whenever a client asked me, what do you think the dollar-euro exchange rate is going to be in a year's time, I've done exactly that. I've just given them the current exchange rate without them noticing. And the general reaction was, makes sense. And not one person has ever caught me out. So there you go. Do we have questions? Yes, over there, please. Veronique is already coming.
Regarding the graph where you compared the tobacco companies and the technology companies. So since the thesis behind that was that you knew that there are going to be some issues with the regulations and so on in the tobacco industry and probably not whatsoever in the technology industry. Would it have been more maybe accurate to compare the performance of indices or sectors in the tobacco industry and the technology industries to see, without the bias of this company or this company, just to understand if the performance would still be the same when comparing two industries? Thank you.
Yeah. Look, I think that's a fair point. The difficulty with indices, an indice keeps changing. So the point I was trying to highlight is even if you go back with this perfect information, if you go back to 1975, you won't have the ability to sort of buy things that haven't happened yet. But actually, even if you did that, you'll find tobacco has done remarkably well relative to technology. I mean, on average, technology has been a very tough space. We think of a handful of shares. If you think how market capitalization works, the winners kind of continue to have more and more say in sort of the weight of the index. Actually, the graph would look very similar, even if you took an index as opposed to the stocks.
There was another question.
Quick question regarding the forecasting. I'm just wondering, and that could be a good segue introducing Jacques, because I know about a little bit about what Jacques has been done over the years. Is it easier to forecast on a micro basis, MICRO, versus on a macro basis? And maybe you can try to link that to the number of people that are forecasting macro all over the place, versus micro on a smaller scale companies, and probably link that to the implicit small cap bias, which we can have, which probably have a lower number of forecasters. Is there some kind of a link that can we make there?
Pierre, just so I understand the question, are you saying is it easier to forecast in smaller markets where you have less variables to deal with?
Kind of, exactly.
Yeah.
Exactly. Where there's less people forecasting, or
yeah.
variables are
Look, in my experience, if you, and this is slightly off track about the forecasting, but if you want to have a chance of doing better in the market, one, you should look where people aren't looking, and a good place to start is where people hate it. And so those two things, where people aren't, other investors aren't looking, and generally a good hunting ground is where other investors hate something. I mean, if you think about how human emotion works, humans, when they don't like something or they think something's bad, they're actually indiscriminate sellers. And then when these assets go down, that actually becomes self-fulfilling in the sense that, look, we knew this was bad. And if I look at our firm over time, the most success we've had is looking for assets in markets where everyone says it's pretty well going to zero. So as a starting point, I think that's probably more effective. I think the forecasting is difficult no matter what. It's aided by the fact that you can do it in markets where others aren't working. But I think the forecasting full stop is difficult because you have individuals whose behavior you're ultimately trying to predict when you're forecasting.
I guess I could answer in a different way. There's a reason why in finance and portfolio management we use a lot more like financial variables, accounting variables and ratios to forecast, for example, like what's going to happen to a stock price or a market than, for example, using economic variables. The reason is that we can relate ratios and financial variables to value, the value of a security. And in fact, it's very difficult to do that if you're using actually economic variables. And economic forecasts in terms of basically forecasting like asset returns have a very poor track record, despite the fact that normally all of these financial ratios that we use are supposed to be proxies for economic risk. But we have not achieved the ability to make a relation between these financial ratios and economic risk. So we're using a proxy that works a lot better than what we should be theoretically using because we cannot get valuation out of economic variables.
But I'll just pick up on...
You don't see a link with the small cap bias that we can have?
Well, I mean, we're still talking about basically style factors here, you know. So we're talking about valuation or quality or maybe liquidity, for example, and when we're talking about size. But we still cannot relate this to basically economic factors. You know, GDP growth, for example, and this is exactly what Craig was talking about. Theoretically, we should be using economic variables, but it just has not worked. And this is why the whole financial literature is looking at style factors.
We have a question over there.
I have a loud voice, so maybe I'll start off. When you look at the economic growth in a particular country, it tends to benefit either labor or capital. And I'm wondering to what degree the South African situation could be explained by the fact that maybe the capitalists benefit and labor did not in South Africa.
So that's a great question. So ironically, it depends which industry you look at. So if you just look at gold miners, I mean, if someone told any of us 20 years ago what was going to happen to gold prices, we probably would have said we should own the gold miners. What we didn't appreciate is the strength of unions and the extent to which they could negotiate reset labor contracts or wages at a much faster rate than you effectively pull gold out the ground. There's also some mismanagement issues. I think the South Africa one is highly, highly complicated. It's a very diverse society. The vast majority of individuals actually haven't seen any benefit from economic growth. It's difficult to explain. Actually, it's quite sad because the massive amount of investment we've seen going into Southern Africa, actually most of it has been multinationals, most of it has been held by shareholders. Actually, the average person in the country has probably seen minimal benefit.
Which explains the outsized return.
Exactly. But, that plus the fact that expectations, if you look at the South Africa thing, expectations have been, for the longest time, very low. And so with low expectations comes actually low prices. With low prices relative to earnings or profits, actually they're quite attractive investments. And in fact, I think expectations, in addition to what I mentioned to Pierre about looking in parts of the world that are unloved, what usually follows with that is where there's low expectations. Generally, where there's low expectations, it's probably one of the times where you actually get to skew that risk-return distribution in your favor. Because the seller who wants out of something desperately actually doesn't care what price, he just wants out. And if you're a student, you have patience, and you have time on your side, actually you can say, I'm not sure how this is going to play out, but the price at which you're selling me this asset for actually says the future is going to be really bleak. So if I buy it from you today, in fact, and you're right, and the future is really bleak, I probably bought it at a fair price. If the future maybe isn't as bleak as you think, that's probably not a bad investment. The worst investments in my experience are buying something when the future looks rosy. Those are the worst ones because the price that's implicit in that says the future better be rosy just to justify this price. And heaven help you if you're not, and that's the permanent impairment of capital.
I'm going to abuse my power of being up here in front of on all of you with a microphone. A question to Jacques that I was wondering, because Jacques is not only the former president of CFA Montreal, but he's also author of a very interesting book called Successful Investing as a Process. So given what we've heard today from Craig about our lack of ability of forecasting, how do I build a successful investment process without forecasting or reflecting this uncertainty?
Actually, I'm going to do a little bit of publicity because there's another book coming out in January called Rational Investing, and that book has two interesting chapters, and one is about luck. How big is the impact of luck in our industry? So that was very interesting. And the other one is about our ability to forecast in the field of social science. And I come to the same conclusion that extremely weak. And to make a long answer even longer, in the book, basically, I took the example of 4 individuals that were credited with forecasting the financial crisis of 2008, and I actually looked at what they actually said. They actually forecast the financial crisis, and in one case actually he didn't, but always said that he did. So if you actually looked at the transcript, but also what I did is I looked at all of their forecasts between 1999 and 2013, and they were in 3 out of 4 cases incredibly bad. And in one case, for example, one person forecasted 7 recessions, including one in 2011 and one in 2013, basically. So eventually, if you forecast a recession every year, eventually it's going to happen. So my point is, going back to this, our ability to forecast, is extremely weak, and you can look at it also from a quantitative, point of view and quantitative point of view, and the best model out there until recently, forecasting accuracy using basically traditional econometric model at a 1-year horizon, it's about like 3-4%, and it's 3-4% accuracy, and 3-4% actually very useful if your horizon is 30 years, but if your horizon is 5 years, 3-4% is not going to do it. So in the end, we're back to what Craig was basically saying. Building a portfolio without forecasting. A lot of it has to do with basically having proper diversification and having proper diversification of securities that have the right characteristics. And a lot of these characteristics have to do with valuation properties. Yeah. And so basically, this is what we actually advise in the first book. In the second book, is that it's all about basically having proper diversification of securities having the proper characteristics and their valuation type of characteristic. And I'm not saying that forecasting should be totally avoided, but what I'm saying is that there actually an article that was done recently, I think it was by Jennifer Bender, that used to be with MCI, but basically was saying that when we look at the best managers out there, the one that were top quartile traditional active manager, 80% of their performance could be explained by the characteristics of securities that the managers were basically buying, and so you actually didn't need the manager to achieve 80% of the result.
Thank you. Joanne, you had a question?
Yeah, I guess just a methodological point that I think will make your case even more. So in the first half of your talk, you put up a lot of time series where there was a lot of trend, and you looked at a regression, you got 95% that got reduced, one lag ahead. So one of the best practices that I've always followed is in looking at forecasting, you should just look at the changes. So basically, you should present it in a way that the forecast is no change, and then see or an R squared of 0, right? And then see if the forecasted change has any positive R squared, right? Yeah, it's just a little bit of a cleaner way of showing that that it's that there is a high degree of trend in the data, and pretty much just saying that the current market environment reflects all expectations, and it's very difficult to have a look ahead. So I just wondered if you looked at the changes or done that sort of analysis.
We actually have. What we struggled with here is trying to put it in a format that's
Yeah.
presentable. You don't
Presentable.
lose everyone.
Absolutely, I get that.
So,
yes.
and that's why we've gone through lots of iterations from tables to more significant
Right,
statistics.
right.
And then, even when you lose half the people in the firm talking about it, you think, okay, well, that's not going to work.
Yeah,
And just
okay.
the chart with the line overlaid it felt like the
Very
right way to get the
intuitive,
message.
right.
But I think but your point's very well said. Yeah.
Thank you.
So next time I'll do the presentation to you, we'll do that chart. Thank you.
We have a question over there.
The question here, you said one good investment strategy would buy what people dislike. Is that forecasting behavior? Is this a way to actually have a new, different forecast way?
Sorry, that's directed at me, right? Yeah. Look, I think being contrarian is a great way to start thinking about investing. But being blindly contrarian is really dangerous. Like, driving home on the wrong side of the road is contrarian, but probably not smart. I think investing is a little bit the same. If you can overlay being contrarian with being thoughtful, and it's amazing how investors, in my experience, make two common mistakes. One, they think about macro, and two, they're very short-term focused. And if you can sort of think about what assumptions are they making with the decision they're doing to sell, I think you have a massive edge. But you just have to be careful. I mean, markets are very efficient. Markets are actually very efficient. You have to overlay it with deep fundamental research. But my point is really, if you want to find a great place to start, if the alternative is trying to think about the future and predict all these things, I'm saying actually if you focus on things like cheap or price, you have a much better chance at starting to think about things the right way.
I would just add to this basically that, in the literature, when we talk about style factors, we still don't know if these are risk premium or behavioral basically manifestation. So there's nothing in the literature that says that these are really, really risk factors that are going to be compensated over the long run, or behavioral basically manifestation are going to be compensated in the long run. We still don't know, and we'll never be able actually to prove that scientifically. So it can be a risk factor, it can be a behavioral factor. But in both cases, I don't really care, because in both cases, theoretically, they would be persistent, because there's one thing that we've realized is that people don't change, And, when I was writing the first book, Successful Investing as a Process, I have examples in there of behavior that occurred in the 30s. And I could see the same type of behavior occurring in the 90s. So we think we've learned a lot more, and probably we have learned a lot more in some aspects. But in terms of behavior, we still have the same type of basically behavioral biases that we used to, and probably it's going to be true for a long time.
We have time for one more question. Unfortunately, I think you had something, one last question? Okay, Ted.
I have one statement, and I don't need the microphone. Okay, I'm looking now. I have one statement and one question. Craig, that was one of the best presentations I've ever heard, and I've heard a lot of them.
Thank you.
The question is, why don't you have a CFA charter?
The response is I do, so I'm not sure why you think I don't.
But it's up there.
Oh, I actually didn't control the presentation, but I'm a CFA charter holder. But just for the record, I think I did it at a time where you had to show up and sign your name. I'm not sure, it was a long time ago. David, I apologize. It was a long time ago. So, but I do. So, thank you.
Okay. Well, thank you all for coming today. I think this concludes our session today. And in particular, thank you very much to Craig and Jacques.
Pleasure.
And please all give him a warm round of applause.
Thank you. Before you leave, please have more wine and food. There's a lot. So if you want to chat, feel free. I just have two things I want to announce. Our next two events of CFA Montreal. So please do not miss November 1st. We have our forum on the impact of research and technology on asset management. We have a great lineup of 4 speakers, including Martin Ford, the author of Rise of the Robot. All participants will get an autographed book. And on November 15, our Grande Conférence at the Palais des Congrès. After Ben Bernanke in 2014, and last year we had Paul Krugman versus Kenneth Rogoff. This year, please come learn about the views and corporate culture, and it's quite a unique one, of Bridgewater. we have invited Bob Prince, the co-CEO. Come discover the secrets behind the radical truth and the radical transparency. Bridgewater promotes a culture of pain plus reflection equals progress. I don't know if it's the same culture at the Institute. So do not miss these events. Bring your clients, bring your friends, bring your colleagues. It's a way better outing than a hockey game. So please stay close to your society, follow us on social media, and be active ambassadors. Thank you very much.